Hello, ladies and gentlemen. Welcome back to Reserved Investments, and thank you for joining me. We're going to begin this video with a story. Back in 2008, famed investor Warren Buffett issued a challenge to the hedge fund industry, where he specifically stated that he would bet any hedge fund manager $1 million that they could not beat the simple returns of an S&P 500 index fund over the next 10 years. He made this bet repeatedly, and he never lost. He actually won the bet. There was not one hedge fund that could outperform a S&P 500 index fund over the period of 10 years between 2008 and 2018. As a matter of fact, most hedge funds conceded their loss by 2015. So even before the 10-year period was up, they knew an S&P 500 index fund was going to beat them at their own game. So this begs the question. This should actually beg several questions to a lot of my viewers out there. Number one, why don't more people invest in traditional financial assets before getting into more speculative assets like antiques and collectibles, what we talk about in this channel, or cryptocurrency, heaven forbid, or gold and silver? And number two, if that's the case, and a simple S&P 500 index fund can beat out a hedge fund, why would anybody take the risk and choose to invest and pay more hefty fees to invest in a hedge fund? These are the questions that we are going to answer in today's video. Because you see, there are reasons, if you are a responsible investor, if you're somebody who's already financially established, and you have a well-diversified portfolio already set up, or at least you are working on setting up, there are reasons you may wish to diversify in the antiques and collectibles trade. And this is something that merits a conversation, because a lot of the commentary I get from the Timmys, Kimmys, and Poindexters that watch this channel and don't understand the scope of what I'm trying to do here is, Sean, you're always so bearish, or you're always so cynical against the antiques and collectibles trade. And you guys have to understand, this is a hardcore collectibles finance channel. I'm not here to blow smoke up your proverbial ass. I'm not here to take you by the hand, walk down nostalgia lane. How many times do I have to say this? Where you tell me how you felt the first time you saw a Star Wars movie on the big screen, or the first time maybe you played a Pokemon video game, or maybe it was the first time that you discovered Magic the Gathering or read a Batman comic book. In all honesty, it doesn't matter, because again, we're talking about collectible finance. What I do on this channel is I teach the fundamentals of investing in the antiques and collectibles trade, both over the short term and over the long term. I kind of take you by my hand and I take you behind the scenes as to how these markets truly work, not how you think or want them to work. And that's where we have a core difference. This is why I tell you guys, this channel may not be for you. If you're somebody that doesn't want this information to pretty much permeate your mind, meaning you don't want to know all this, you just want to love Pokemon, you just want to love vintage toys, you just want to love comic books, it's probably best that you do you and you forget that this channel exists. For the rest of you that do want a lesson in how these markets work, this is where I come into play. This is why this is a non-hype driven YouTube channel. There's a lot of fluff. There's a lot of bad advice out there. You know, I was just talking with a friend about this just recently. And for those of you unaware, over the next month, I'm going to turn 47 years of age. I am almost 50 years of age. And a lot of the people that I'm friends with, a lot of the people that I communicate with on a daily basis, they remember the world before it was, without the internet, without YouTube, without any form of social media. They remember how the world was before cell phones came into existence. And for the record, I was an early adopter of both internet technology and also cell phones. I got my first cell phone in 1994. Believe it or not. And I paid $50 a month, or I should say my parents paid $50 a month, and I got 30 minutes to talk to whoever I wanted it to in that month. Now, obviously, my parents were paying the bill so that if there was an emergency and they reached out to me, they could get a hold of me and they knew where I was. It wasn't like I was using it to call up crazy chicks or to interact with friends, because in 1994, even in 1995, even in 1996, very few other people owned a cell phone at that particular point in time. Now, where am I going with this? Well, as I was having this conversation with my friend, we lamented how great it was when we were growing up. We didn't have all this hype-driven content that was bombarding us 24/7. Meaning we didn't just turn on our smartphone and see some crazy dude telling you to buy houses with no money down. Some other crazy dude telling you how to hook up with a lot of chicks. And some other crazy dude telling you to put all your money in comic books. And then another crazy dude coming along 10 minutes later telling you, no, cryptocurrency is the next big thing. Or no, you should use this method to invest in meme stocks and you'll be a multi-millionaire in 10 years. All this information, all this fluff that is floating about out there on all these algorithms, it is having a drastic effect on young people. It is having a drastic effect on their self-esteem. They're comparing themselves to other individuals. They're asking, am I good enough? Do I look good enough? Do I look like this individual? I want to look like this individual. I want to date a person that looks like this. I want to have this car. I want to have this house. I want to have this watch. I need to do it all by the time I'm 30. All this information is having a negative impact on society by and large. And that's why I created this channel, to cut through that hype, so that when you come here and you learn at least about investing and potentially investing in antiques and collectibles, you don't do anything stupid. Because I can assure you, as a consultant in the antiques and collectibles trade, I see it all. Good, bad, indifferent, people that get obsessed with these markets, people that get a credit card and they do some insane stuff to the point where they're in debt now for the next 10, 20 years, where they have to work 2 jobs to pay off the credit card because they listened to the wrong YouTuber, or they took certain advice to heart that they probably shouldn't have. I've seen relationships ruined. I've seen people do crazy things in the dating world. I've seen people hook up with people they should not have hooked up with. Remember, short-term relations usually equate to Me Too allegations in this day and age, for those of you out there that are unfortunately misogynistic and red-pilled in nature. It's one of the sayings that I have on this particular channel. You have to understand that in most cases, it's hype, it's content-driven material that is generating a profit for the person putting it out, that is taking advantage of your naivety in a lot of these subjects. And what I attempt to do on this channel is just teach the basics. So let's talk. Why do people choose to diversify in the antiques and collectibles, knowing that in most cases, an S&P 500 index fund is all you need, especially if you're young? If that's all you want to invest in for the next 10, 15, 20 years, you can make a go of that. Now, I would always encourage you to speak with a licensed financial professional. Don't trust anybody that is recording a YouTube in a basement office at 1 a.m. But that said, why then do people choose to diversify in antiques and collectibles? Let's talk about this. The main reason, as stated before, is diversification. Usually, in certain scenarios, when traditional asset classes, like stocks, bonds, mutual funds, ETFs, when they're on the up and up, in certain cases, antiques and collectibles may be dropping in value because people are putting all their money in financial assets, and you can find bargains in the overall antiques and collectibles trade. In other instances, when financial assets are dropping in value or are down in value, certain antiques and collectibles, they're booming. And if you know how to profit from these markets, you can sell into the hype. Now, obviously, in the macroeconomic environment that we find ourselves in 2023, with inflation that was rearing its ugly head, with the Fed moving rates up to near. I'm not going to use the term historic because everybody cuts me up in the comment section, because there are people that watch this channel that are in their 60s and 70s who state, Sean, I was alive in the late 1970s, early 80s when rates were like at 14%. So I'm not going to use the term historic anymore, but what I'm going to say is the rates that we're seeing right now are historic to most people who are in their 20s and 30s, okay? Now, normally when that happens, you can have a period of time where all asset classes are pretty much not performing very well, bottoming out, or just pretty much going along with a lot of volatility, which is where we find ourselves now, with the overall stock market humming along. It's doing okay, not doing great. Then you have antiques and collectibles, some of which have dropped 20, 30, 40, in certain instances 50% or more if you were stupid enough to invest in great video games during the bubble, certain comic books, certain pop culture collectibles. You need to understand that some of those markets are not coming back to the high prices that they were once selling at. This is why we diversify in antiques and collectibles. It should never be the core holding of your entire investment portfolio. Nothing speculative should be, okay? Now, another reason we choose to diversify into antiques and collectibles is because private ownership. These particular items can make a good store of value if you buy right and you understand what you're doing. One of the core fundamentals that I teach on this particular YouTube channel is always remember, if you are investing in anything that is considered a collectible, especially pop culture in nature, those particular items are rooted in nostalgia. If you are investing in antiques, items like rare coins, currency, historical documents, certain weapons, items of that nature, those particular items are rooted in history. Over the long term, history will always outperform that of nostalgia. Remember, guys, collectibles are more linear. Antiques are more cyclical. That doesn't mean that antiques and antique categories can't die out. They can, but they're more cyclical in nature. There's more of a chance of those items coming back in vogue and you getting a return on your investment if you do buy wrong on the antique side of the equation than that of the collectibles side of the equation. Always remember that. Now, another thing we have to look at too when we talk about a store of value with the private ownership of this stuff, if you have a rare coin, if you have a comic book, and you want to pass it down, meaning you know you're going to die with it, but you want your kid, Timmy S. Poindexter, to get that particular item, all you got to do is just give it to him. There's no formal transfer of the asset, which would be needed if you were willing somebody an investment portfolio, stocks that you wanted them to have, financial assets. When it comes to antiques, collectibles, any of this stuff in physical form, you can just hand it to them. Now, I'm not telling you to do anything illegal. Please always check with financial advisors, accountants, attorneys, and the like. But I'm just stating it is much easier to transfer a rare coin, a comic book, a painting, whatever it is to someone than that of an investment portfolio. Let's be realistic. So that is another reason that people choose to diversify in antiques and collectibles. And if you have a lot of money, if you have hundreds of thousands of dollars sitting, millions of dollars sitting, it makes sense if you have a passion towards antiques and collectibles to choose to invest in these markets with whatever you're comfortable with risking in these markets. Now, to be clear, I always state no more than 20% of your entire investment portfolio should be in speculative assets. And by speculative assets, I mean pretty much any asset class does not have underlying cash flows linked to it. So we're talking antiques, collectibles, cryptocurrency, gold, silver, items of that nature. So you got to be careful here, because what a lot of people will do is they'll put 10% of their entire investment portfolio in antiques and collectibles, another 10% in gold and silver, another 10% in crypto. Now, when you go back and you look at the breakdown, your allotment of your investment portfolio, 30% of it is now in speculative assets. You got to be very careful with that. Another reason we choose to potentially invest in antiques and collectibles is obviously the potential for appreciation. Again, if you have an asset class that has an inverse relationship to that of Wall Street, to that of stocks, bonds, mutual funds, ETFs, you really get a double whammy here. And I mean that in a good way. You can take that particular asset class, that collectible that is accelerating in value while Wall Street is dropping. You can sell it, and then you can take the profit and you can invest in those depreciated Wall Street assets at a discount. So now when that market recovers, you got the best of both worlds. This is why I get so mad when people come into the comment section telling me they're putting all their money in gold and silver. I have nothing against people that want to put like 10% of their entire investment portfolio in gold and silver, provided they understand that if that particular asset class of precious metals pops, they sell into that upturn, they take that money and they invest it in a depreciating asset class. Because believe it or not, gold and silver, in certain instances, they have an inverse relationship with financial assets. So during the financial crisis, to use this as an example, back around 2010, 2011, silver started going crazy. This is also during the time when gold started going crazy. Silver was up to, I think, $38, $39 an ounce. And I had access at the time to a lot of it that pretty much I got some of it from my grandfather. I had some of it on hand. And I remember looking at the price, and when it started to hit $35 an ounce, I sold into the market a substantial amount of silver. I took the profits from that, and I put all that money in an S&P 500 index fund back in 2011, because that particular asset class, due to the financial crisis, was still bottoming out at that particular point in time. It was down significantly. And I knew when that market corrected, I would get hit with not only the gains from selling that silver, but also now the gains because I took that profit and put it in an S&P 500 index fund and just waited for the market to rebound. What really ticks me off about people that try to invest in silver and gold is when the market goes up, they listen to all these conspiracy theories and they listen to crazy people telling them that everything's going to go to zero. You need to hoard gold and silver. So they make the mistake where they keep hoarding it. This is why when you guys ask me what I think about silver stackers, gold stackers that have YouTube channels, in my honest opinion, I do not agree with their investment strategies for those reasons. Again, if there's any silver stackers watching this video, gold stackers, if you guys only have like 10 to 20% of your portfolio geared towards gold and silver, and you sell when it goes up in value, and you take advantage of other depreciating assets, you have my utmost respect. But most of you don't do that. You keep buying more and you double down on the investment. This is why you will see in a lot of small towns, rural areas, you will see older individuals. You'll hear that they died in their sleep, and literally the authorities, they had no one, they went into the house, and literally they found like 25 ounces of gold and 100 ounces of silver in the house, because that was that particular individual's retirement fund, meaning they were just hoarding gold and silver. They had no investment strategy attached to it. I assure you, in most cases, like a 99.9% chance, the entire economic system is not going to crash and burn. You guys that are listening to conspiracy theories, whether you're crypto bros, whether you're gold and silver bros, whatever it is, you need to take a step back and analyze your investment strategy, because you can make money in those markets, but you have to be willing to sell into the hype. Case in point, cryptocurrency. Back, what was it? 2019, maybe 2018, cryptocurrency, especially Bitcoin in particular, hit like $60,000 to $70,000 a coin. And you would turn on the radio, you would turn on the TV, and there were people telling you, mortgage companies, you need to refinance your house and buy the Bitcoin bump. Buy into Bitcoin and invest in that asset class because it just keeps going up and up. How many people bought into Bitcoin at the high price back then when it was $60,000 to $70,000 a coin? Today, you guys are hurting. This is why I tell you, you try to buy as low as possible and you sell at the high price point. Again, when it comes to holding financial assets, you hold financial assets for the long term. You do not buy in and out of an S&P 500 index fund, a total stock market index fund. Reason being is you cannot time the market. Time in the financial markets is where you want to be for the long term. You don't want to be trying to time the markets. It's no different when people engage in options trading. Options trading is inherently risky, not due to the volatility of the market, but because, again, you're betting against time. You are placing a bet that something is going to happen at this particular point in time to this asset. That's a Timmy move. You are a Timmy, Kimmy, or a Poindexter if you are attempting to do that, and more than likely you're going to get slapped in the face with a stale donut. Now let's continue our discussion here, because obviously there is one last glaring reason that most people choose to diversify into antiques and collectibles, and we got to talk about it. Nostalgia is a big part of this. This is why a lot of people, when they invest in these markets, even when you give them all the information that I have given you guys free of charge on this YouTube channel, even when I tell you where to get it, for instance, if you're a coin collector, if you subscribe to the publication known as Coin World, you actually get this nifty, handy guide that talks about the Rare Coin Market Index. And this comes free with every issue. And if you look in it, it actually shows you the actual returns of certain coins from the 1970s all the way up to today. And you can actually use this information to compare the return of certain coins to that of the overall returns of the stock market and or an S&P 500 index fund. This is something that is used a lot by coin dealers and rare coin investors. I've said this before. Investing in coins is probably one of the most sophisticated markets in the entire antiques and collectibles trade, and it's always highly liquid. That's why people choose to invest in this market over the long term. Now, where am I going with this? Well, even when people are armed with this much information and data, if they have an emotional attachment to a lot of these coins, are you aware, even if they're up in certain cases 3,000%, they still will not sell the coin. This is why you have to keep nostalgia and emotion in check. This can destroy you when we're talking about alternate asset investing. And this is something that I always say on this channel. The average individual, the average investor, does not get emotionally attached to an S&P 500 index fund. They do, however, get emotionally attached to comic books or video games, or to go back to my original example, in certain instances, rare coins. You have to be able to control that if you're going to be a successful investor. Now that we are 23 minutes into this video, most people shut the video off by now. We can have some fun here. Let's do this, guys. Let's talk about Timmy's investment portfolio. This is what not to do. See, a lot of Timmys, unfortunately, invest in the 4 C's. A lot of Timmys go after crypto, commodities, mainly gold and silver, collectibles, and crazy chicks. Now, I want to be clear here. I'm not telling you to not pursue or date women. I'm telling you not to go after crazy chicks, meaning promiscuous women with attachment issues and possible personality disorders. Those are the women you want to avoid in the world today if you're a guy. However, Timmy, he goes after all this stuff. He goes out and puts all of his money in cryptocurrency, commodities, because everything's going to zero. He's buying gold, silver. He then watches Pokemon channels. He watches Magic the Gathering channels. He watches comic book investing channels, action figure channels, video game channels, and he puts what's left in collectibles. Then he chases after crazy chicks. And guess what happens? Timmy just discovered the 4 C's of bankruptcy. Now, those of you that have watched some of my earlier videos, you know, if you are attempting to invest in collectibles, I tell you to go after the 4 C's of investing in collectibles, which are coins, currency, cards, and comics. Please do not do what Timmy does. You cannot put all of your money in cryptocurrency, gold, silver, collectibles, and or crazy chicks and expect it to work for you. You are going to get slapped in the face with the stale donut. Always remember, guys, the Overstreet comic book price guide that is published yearly is a great resource. This one's covered in dust. You can probably see the dust falling off of it, believe it or not. It's a great resource, but this is not an investment guide. Please, if you are thinking of investing in antiques and collectibles or cryptocurrency, which I would not recommend at all, even gold and silver should not be at the top of your list of things to invest in. Please, please attempt to build a diversified financial portfolio first. More on this is going to be discussed in more upcoming videos. Thank you for watching. Please let me know your comments in the comment section below.